Okay, looks like some attendees are starting to trickle in here. We'll give everyone maybe another minute or so before we kick it off. Looks like we also have Key joining. I've made him a panelist as well.
Okay. Hi, Pierre.
Hi, Key. How are you?
Pretty good. Yeah, I remember we gave you a beta access like 3 years ago.
Thank you for that.
Okay, we'll give it one more minute or so before we kick it off, as people are still trickling in. Is that Pierre? I was going to ask, is that a picture of Riot mining facility or another one in the background?
Only Riots.
Only Riot.
Yeah, biggest one in the world.
That's awesome.
Is that in Rockdale, Pierre?
It is, yeah. It's in Rockdale. It's one of several buildings.
Yeah, there was a aluminum smelter there.
That's right.
Yeah.
Yeah, Alcoa.
Yeah, Alcoa. I worked in the aluminum industry before.
Oh yeah.
Before, yeah, as a research analyst for aluminum. So I know, where's every plant in the world for primary aluminum. So
that's cool.
Yeah.
Yeah, a lot of the people who work at our mining facility either used to work at Alcoa or have family that used to work at Alcoa.
Yeah.
Revitalizing the community.
Nice. Yeah.
Okay, let's get this started. We have a good amount of attendees so far, and we'll let others continue to trickle in. So just a few housekeeping items before we start. First of all, thank you everyone for joining this first monthly webinar series. We have Pierre Rocahrd joining us from Riot Platforms. This will be our first webinar in our monthly series that we're going to be doing, where we'll be inviting industry leaders to come speak with us about various topics, everything from Bitcoin and crypto mining, or Bitcoin rather mining, which we'll be talking about today, all the way to the broader digital asset market. So joining me from CryptoQuant is my colleague, Julio. Julio is lead analyst on our research team. He's the researcher behind our weekly crypto and Bitcoin reports, and is also a Bitcoin consultant for some of CryptoQuant's institutional clients, including major banks and hedge funds. And also joining us, our special guest is Pierre Rocahrd. Pierre is the VP of research at Riot Platforms, focusing on Bitcoin protocol improvements, mining, and sharing his knowledge and research both within the company and across the industry. And for those who haven't guessed it already, Riot is a public US Bitcoin mining company trading on NASDAQ under the ticker symbol Riot, which is a cool ticker symbol, I must say. So prior to Riot, also, Pierre was working at Kraken Exchange as a product manager. And there he had also led product development initiatives, including where he implemented instant and free Bitcoin funding with Lightning. And also myself, for those of you who don't know, I oversee CryptoQuant's institutional business, including strategy and business development. So just in terms of content today, Julio and Pierre will be covering recent Bitcoin mining activity. And stay for the end because we'll also be touching on some other subjects, including developments within the regulatory space, and also areas including institutional sentiment as well. So definitely stay till the end. And if anyone has any questions throughout the discussion, feel free to put them in the Q&A section, and we'll get to those at the end as well. So with all of that out of the way, Julio, I'll hand it over to you and let's kick off the session.
Thank you, Ben, and thank you everyone for joining, and thank you, Pierre, for accepting our invitation. So just quick how this webinar will be structured. Yeah, mainly 5 sections. So the first section will talk about generally what Bitcoin miners do, what they are and they aren't. Second section is just the current miner situation after last year's price correction, how are miners doing in this context. Third, the USA mining landscape. Fourth, the miners in the context of the recent increase in Bitcoin network activity. And then just the general analysis, an outlook for Bitcoin and some regulatory developments. So I'll kick it with the first section. Pierre, you have I would say a unique view on what Bitcoin miners do and what they don't do, and you even say that you don't like the term miner for what they do, and you'll come up with another term to better define miners. So it will be interesting just to have your thoughts on this, on what Bitcoin miners really are.
Yeah, thank you. I wish I could take credit for it, but of course I have to give credit to Satoshi because I'm just regurgitating what he wrote in the Bitcoin white paper. So I think that the term miner does make sense in a particular context as an analogy for what proof of work does, because there's 2 parts to proof of work. One is adding new Bitcoin to the ledger. So this is called the subsidy, and it really represents a transfer of Bitcoin from the issuance schedule of that 21 million Bitcoin to the UTXO set that is able to be used for transactional purposes. So that subsidy, the issuance of new Bitcoin, is what Satoshi analogized to gold mining, which is extracting the commodity from the ground using work so that it can be usable, so that people can transact with it. So I think it's fine as an analogy. It does, however, miss the second part of what proof of work does, which is proof of work plus the difficulty adjustment. And this is what some folks refer to as the time chain, which is basically this concept that Bitcoin mining is a decentralized clock. And so a block comes out every 10 minutes. And if blocks are coming out too quickly, then the Bitcoin nodes increase the difficulty. And that happens every 2016 blocks. And if they increase the difficulty, that means that it goes back to being every 10 minutes and vice versa. So they can also decrease the difficulty if blocks are coming in too slowly. And that's a way of essentially rate limiting the miners so that the miners don't produce too many blocks too quickly. And it allows Bitcoin to really be a very dynamic and anti-fragile system in that regard. So timestamping is a way of capturing that second functionality. And really, though, I shouldn't say it's the second functionality, because if we look at what is actually innovative about Bitcoin, that timestamping is Satoshi's invention. It is the solution to the double spending problem. And that is what really makes Bitcoin, a novel system. So I think that bringing that back as and emphasizing that really, that problem of double spending, of spending the same coins twice, this is the first time there has been a decentralized solution to that. And without this decentralized clock, that is ordering transactions over time, there really would be no way to have a decentralized ledger, and there would be no way to have any kind of digital scarcity. So it's all deeply interconnected of Bitcoin miners using work to convert energy into time. The other part that then if we, Bitcoin's like an onion, you can just keep peeling it and there's layers below. The layer below is that it's actually unrelated to time. And this is something that Peter Todd very patiently explained to me, is that there just needs to be a sequencing of sets of transactions, but the sequencing does not necessarily have to be time related. There just has to be one canonical kind of chain of blocks. So I thought that was a really interesting insight, although in practice today, the way Bitcoin is implemented is that it does rely on time.
And what do you think, naming it as a correct term for miners or timestampers is important because it leads to maybe to misconceptions about what really miners do, right? One of those misconceptions is that miners can control Bitcoin and the network, right? So can you touch on that, on what if are miners really in control of on the network, and what do you think about that?
Yeah, that's a good insight. So because miners are the ones that are creating blocks, there's a perception that they determine the rules for the blocks. The reality is that miners are just proposing blocks, and then the network of nodes are verifying that the block is following the expected rules. And this isn't just like a theory of mine. If we look at what happened a few years ago, there was a mining pool called F2 pool, and they created a block that accidentally created more Bitcoin than they were entitled to. And so it was an invalid block because it did not follow the rules of the Bitcoin protocol as implemented in the node software. And so all of the nodes rejected that block as invalid, and F2 pool lost out on that revenue. So it's really important to keep in mind that the Bitcoin as a system has checks and balances, where the miners are proposing blocks, but ultimately any node can veto a block for themselves. But a node cannot veto blocks for other nodes, right? So this is where it's tricky, because Bitcoin is what's called an intersubjective consensus, meaning that each node is operating independently, but if you are trying to facilitate economic activity between the different nodes, they have to be compatible. Otherwise, somebody will tell you, hey, I'm sending you Bitcoin, and then your node is not compatible and thus does not see the transaction that they are sending you, and you're just, everyone's just scratching their heads. So it's a really interesting situation where every Bitcoin node is sovereign, but at the same time, no single node is sovereign. And so that's what makes Bitcoin decentralized at the end of the day. And that's why it has accrued so much value over the past decade.
Yeah, so just to take that out of the ways, like, because you hear a lot of that on the press, on media, like miners control the network and they can do, pretty much whatever they want. But just to the people to be clear, is we have another, as you say, another layer of protection is the nodes, right? The nodes are the ones, and the nodes can be run by anyone. So I have a node here in my house. It's just a small computer, and that one is, accepting or not the blocks that miners propose. So that's the, how it is structured. Yeah, and another, I guess another misconception is that miners are solving really complicated problems, math problems, right? So can you just mention what they're really doing?
Yeah, so I mean, to give credit to the folks who have that view, SHA-256 is a complicated math problem. I would not want to do a SHA-256 hash by hand. But from a computer science perspective, it's a very simple math problem. So there's kind of the two sides of the coin there. And SHA-256, and really any hash function, basically the idea is that you put data into the function, and then as the output, on the other side of the function, you get a fixed length random zeros and ones. For SHA-256, as you might guess, it's 256 zeros and ones that are completely random based on the data you put in. Now, if you put the same data through the same function, you get the same output. So hash functions are deterministic. And that is really important in Bitcoin because ultimately when the Bitcoin nodes are verifying a block, they run the same data through that same hash function in order to get the same results that the miner got. Now, critically, what the nodes verify is that the resulting hash has enough leading zeros to be above the difficulty. I'd mentioned the difficulty earlier is set to make it so that there's a block every 10 minutes. So when you look at the network statistics or the mining hash rate statistics, you might see, for example, that there's 300 exahash per second. So exa, for those who are familiar with the metric system, I mean, it's an astronomical number. It's just, it's a lot of hashes per second, so that every 10 minutes on average, they find one hash that has enough leading zeros to meet the difficulty level, and thus to have a valid block that can append transactions to the Bitcoin ledger. So that's where it's not really the complexity of the math problem, it's how many times you have to do the math problem that is challenging. And so it's a lot more like trying to enter lots of lottery tickets into the lottery so that you get lucky enough to have the right numbers drawn, every 10 minutes. So, luck is a factor in Bitcoin mining. But ultimately, it's about how many hashes can you generate and to find enough leading zeros.
Yeah, and so basically it's a trial and error what they're doing, right? So just they input all the data from the block and then hash it, right? And let's say you need to find that one that is valid, right? So you need to do this like a lot of times per second to win that block, to be the one that finds that block, right?
Yeah, that's right. And I think that one of the problems with the Bitcoin mining terminology is that it amplifies kind of the narrative that this is bad for the environment, because instead of thinking about Bitcoin mining or proof of work as computer servers that are generating cryptographic hashes, they start thinking about it as like mineral extraction from the soil. And if you go into a Bitcoin mining facility, there's no CO2 emissions going on inside the facility, right? There's just a bunch of servers that are operating at 100% and generating hashes. So I think that's the other problem with the terminology of mining, is that it gives people kind of a bias that this is terrible for the environment, when in reality, it's no more terrible for the environment than running a search query on Google.
And just to jump in there, I think, yeah, you're definitely right in terms of the, maybe the pejorative that is mining, because also when you think of mining, traditionally you think of, an unlimited or unknown amount of minerals or metals that can be extracted from the ground. Whereas in Bitcoin, there's a known amount, there's 21 million, you're not mining them in a sense, you're more just like time stamping the blockchain and getting reward, which has already been kind of calculated. So I think that also is important as well. Mining does have a few different misconceptions associated with it.
Yeah, and the mining analogy becomes less relevant with every halving. And eventually there will not be any new Bitcoin being added to the ledger, and the analogy will be a historical one rather than trying to explain present reality.
Yeah, correct. Let's jump into the next section. Is the current miner situation after 2022. So we saw in 2022, declining prices, Bitcoin down 70% or more. We saw miner flows to exchange spiking because some miners were forced to sell their Bitcoin reserves to finance their operations to get some cash, and some other miners filed for bankruptcy protection in the USA. But still, hash rate still managed to increase to fresh highs, right? So what's your take on what happened last year on the Bitcoin industry?
Yeah, so I think that it's really important when analyzing the Bitcoin mining market to connect it with kind of the real world logistics of the supply chain. And so there is a tremendous lag, anywhere from 12 to 18 months, between what the Bitcoin price is doing on the spot market and how long it takes to build up infrastructure to host miners, to get deliveries of mining rigs, to plug them in. So I think that's why hash rate was hitting records, even though spot market was struggling. And that created a really challenging situation for Bitcoin mining industry participants. Riot's strategy through this has been to be a low-cost producer of Bitcoin, meaning that even if the Bitcoin price is decreasing and that's compressing margins, that we're still profitable and able to and I mean profitable at the machine level. I don't want to get into public filings or anything like that, but we're a public company, so you can go see our financial statements and look at that yourself. But basically, the idea here is that if you're going to be a Bitcoin mining company that lasts through the cycle, one, you have to have a strategy that accepts Bitcoin's volatility. If you try to deny Bitcoin's volatility, then you're going to face financial difficulties when that volatility materializes. And we've seen a number of companies fall into that situation over the past 12 months. So the other part of it is that electricity prices can also fluctuate significantly. And so in a way, it was a bit of a perfect storm because of Russia invading Ukraine and causing natural gas prices to go up, and also just general inflation pressure throughout the world. That drove up electricity prices, meaning that Bitcoin miners were getting squeezed on both sides of electricity prices going up and Bitcoin price going down. So there's that. Riot has had a power management strategy of locking in electricity prices low when the market conditions are appropriate, and then also when electricity prices are high, having an approach of helping the electricity grid out by turning off, by curtailing and freeing up electricity for other participants on the grid, which is done, one, to essentially help stabilize and balance the grid so that there are not negative repercussions of brownouts or blackouts, but two, to also be able to essentially sell power at a high price, and that allows a mining company to have two sources of revenue. One is selling electricity to the Bitcoin network in the form of hash rate, and the other is to sell electricity to the grid. So you can kind of think of a grid miner in that way, and people have analogized it to a battery, which is I think a better analogy than mining is we're a battery, a flexible load on the grid. The other part of Riot's strategy has really been about vertical integration. So this is why we recently changed our name from Riot Blockchain to Riot Platforms. We're now, not only are we a Bitcoin miner that has mining rigs, right? We've got tens of thousands of mining rigs. The other part of it is that we're a real estate company. So Bitcoin mining, it has to happen in a physical location, right? And location matters, right? In the real estate market and in the Bitcoin mining industry as well. You want to be in a location that is close to key strategic points on the grid. Not every acre of land in Texas is the same, because not every acre of land is connected to large, essentially infrastructure to enable high load computing like Bitcoin mining. So Riot's location in Rockdale, near the decommissioned Alcoa aluminum plant, the Sandow switch, that's a strategically important location on the grid. And then Riot's new location, second location in Corsicana, where we have access to 1 gigawatt, is also strategically important. So there's the real estate component. Second is the construction. Riot is also a construction company. So we build our own buildings, and we, lay the foundation, we move dirt, dig ditches, lay conduit, all of this. And also within the building, we build our own shelves, our own racks that are custom for Bitcoin mining. We build our own immersion tubs. So all of this infrastructure is purpose-built for Bitcoin mining. And that allows for, one, is kind of keeping costs low, right? So, finding ways to be resourceful. And two, making sure that it's fit for purpose. So if you try to mine Bitcoin in a traditional data center, you're going to have, it's not going to be adapted for that use case. And so you're just going to end up having not only higher costs, but a longer time to market. So it's just going to put you behind in both regards. We also acquired an electrical equipment manufacturing and designing company called ESS Metron, based out of Colorado. And as you might imagine, if you're building a Bitcoin mining facility, you need a lot of electrical equipment if you're building at scale. And a lot of it is custom when you're really talking about, significant megawatt usage. So it just made sense to vertically integrate with ESS Metron to be able to further control our supply chain, and make sure that we're able to build faster than the competition so that we can really, get to market as fast as possible. The other part of it is about self-hosting. Self-mining. And that's end-to-end. That's what really makes Riot a platform, a Bitcoin mining platform, rather than just a specific part of the industry.
It's like, I don't know if you've seen the movie The Founder, but it's about the founding of McDonald's. And it was only at the point when he realized he had a real estate company that, he realized how big the opportunity was on his hands. He doesn't run a burger company, he runs a real estate company. And I've seen a lot of other analogies across the entire kind of blockchain, quote unquote, blockchain space, even with CryptoQuant. But, I was speaking with Hut 8 the other day, and they also seem to be getting into another business of, HPC, high performance computing, to try and, I guess, hedge some of the risk associated with just purely being, a Bitcoin timestamper and collecting Bitcoin and having such a huge exposure to one kind of volatile asset class. What other, I'm curious, what other kind of tertiary businesses would you say complement, the Bitcoin mining companies, apart from real estate or perhaps HPC? Are there any other ones that come to mind?
If we think about the vertical integration, one, there's a lot that could be further integrated. But I can't really comment on anything specifically, to be honest, there. And I think that there's also going to be different business models within the Bitcoin mining industry. But yeah, Riot is a long-term believer in Bitcoin. And we hold a significant amount of Bitcoin on our balance sheet, in addition to every Bitcoin on our balance sheet we mined using our facilities and mining rigs. So yeah, I'll leave it there.
Okay, Pierre, and you mentioned 2022 being like the perfect storm, right? So prices declining sharply, electricity costs increasing, and also hash rate increasing and mining difficulty increasing a lot. But for the Bitcoin price, it can be hedged. So there's a way to hedge that. Electricity costs also can be hedged, either financially or, as you said, integrating, maybe securing some electricity at low cost. But what about, hash rate and difficulty increases? It's not really something that you could hedge. And there's been an emergence of financial products that to help miners hedge this hash rate or difficulty risk. Is this something that miners are considering, or in your opinion, what will be a good solution to manage this type of risk?
The best solution for managing that risk is to plug in more miners, right? If you're concerned about losing your share of the hash rate, right? What percentage of the hash rate you have, your market share, then no amount of financial contracts are going to make you more competitive. You're just going to give money to third parties. What you've got to do is either accept your fate or get to work, right? And grow. And so I think that in an environment where the capital markets are challenging, it's hard to get financing, balance sheets are upside down, not Riot's, but others. I understand that it's challenging, but Riot is expanding during the bear market. We've dramatically increased our capacity over the past 12 months, and we'll continue to do so this year. So I really think that rather than hedging hash rate, folks should be adding hash rate, and maybe that means that they've got to find, as we mentioned, other ways to vertically integrate.
But I think, it could be used to, as you said, it takes a lot of time to deploy, right? A new mining facility. So during that time that you deploy, it could take months or years. You're not adding more capacity, and the hash rate is increasing. So maybe, do you think in that in turn, it's a good way to hedge for that, or what are your thoughts?
I guess I'd say, like, every minute spent looking at hash rate hedging is a minute that could be spent plugging in miners. And so there. An analogy I would use, for example, would be, what if Apple spent a lot of time and resources hedging against the unpopularity of the iPhone, right? What if the next iPhone model does not sell very well, and they're trying to find hedging contracts to just in case that happens? It's like, well, just close your business, right? Like, you've already, you're admitting defeat. I think that's the wrong approach to take.
Okay.
And just
Thanks. Well,
following up on that. So just like at a high level, so obviously on the books, a Bitcoin mining company, the largest asset on the books, probably whether it's cash or any other asset, I would assume is just holding Bitcoins. So would you say generally, is that just a kind of hold strategy from like the financial perspective, or is there anything else going on there sometimes?
Yeah, it's really, it's a hold strategy. And it really, I mean, it's about Bitcoin's fundamentals as a scarce commodity that is currently, from my point of view, at least, deeply undervalued by the market. And so it just makes sense to hold it.
okay. So yeah, I mean, we touched on some other topics already, but I want to talk about the USA mining landscape. So we saw, like, after the Chinese mining ban in 2021, like, a lot of hash rate moved to the USA. And now the USA is like the largest country by hash rate. So what do you think? Why did miners come to the USA, and where they're located, and why? What's the why are they located where they are?
Yeah, great question. I can speak to Riot. What makes a lot of sense about Texas is, one, on the energy level, and you've got to start there, is energy, because that's the most important qualifier, is what is your cost of electricity. And Texas has a unique combination of abundant renewables, wind and solar, and abundant reliables, natural gas. And natural gas is the most cost-effective, reliable source of electricity. Second is the property rights and institutions. All right, so there, I think Texas is a leader. And so making sure that you have rule of law, and that, what happened in China was undemocratic, right? They unilaterally decided to crack down on Bitcoin mining without any kind of public debate or vote or conversation around it. And that's, I think, those are the two key elements. And then there's also just the physical infrastructure. Is it buildable, or does it already exist? And so I think that's why the United States in general has attracted a lot of Bitcoin miners, is that you can still build things in the United States.
And do you think that now that first we had like China, a lot of miners in China, right? It's like centralization, but now we have a lot of on the USA. Do you think there's also a risk for Bitcoin mining, that kind of concentration in the USA, with maybe regulations coming for miners, or that this debate about the environment, right? That maybe Bitcoin miners are not good for that. Do you think that's a risk, or how do you see that?
Yeah, good question. So I think that throughout my time in Bitcoin, until I guess 2021, when China, really reduced the amount of Bitcoin mining going on. Although there's still, I think, an estimated 20% of the hash rate in China, which is really interesting. There's been this overarching concern about how much hash rate is in China, and what the 2017 block size war and debate really revealed was that it doesn't matter how much hash rate is in any particular jurisdiction, or how much hash rate is behind a protocol change, because the miners were, I think, more than 90% were signaling for a hard fork to double the block size limit to 2 megabytes. And ultimately they failed because of Bitcoin's decentralized governance, but maybe that's why the Chinese Communist Party decided to kick them out, is that their presence in China did not actually give China any control over the network. And so there's not really any strategic interest to have Bitcoin mining in your country. Now, as for the situation in the United States currently, I think that it's very instructive to show that the ban or the reduction in mining in China, that did not just make mining go away. All it did is it pushed it offshore. And so if the United States were to pass regulations that are that make it uneconomical to mine Bitcoin in the United States, that just means that Bitcoin mining would move to other jurisdictions, or it would go underground like it did in China, where there's still 20% of the hash rate. And from a policy perspective, there's two consequences. One is that the government doesn't collect tax revenue if Bitcoin mining is done on the black market, which, you know, depending on your political perspective, is a good thing or a bad thing. Two is that Bitcoin mining then uses electricity that is being generated by you know, more CO2 emissions than otherwise would happen. Basically, a Bitcoin mining facility like Riot's has a more renewable footprint than a Bitcoin mining facility in Kazakhstan that is operating on 100% coal, right? In Texas, it's more like 50% renewables. So, you know, pushing Bitcoin mining abroad would cause more CO2 emissions, not fewer. So I don't think that there's a strong policy argument for the folks who want to crack down on Bitcoin mining in the US. But the debate has to happen in any case. And it is what it is. That's part of being in a democracy, right?
Yeah, and you also, we were talking about, you know, the benefits of mining, and you have touched on that also. But one of the benefits that I see is, you know, employment, bringing back employment to communities. Like, for instance, we were talking about your facility in Rockdale. It used to be a primary aluminum plant owned by Alcoa. It shut down because it wasn't not economically viable. So some of those facilities are being taken over by Bitcoin miners and bringing employment also to those places. What are the other benefits that you see from Bitcoin mining?
Yeah, so Riot, as of December 31st, employed 489 people. We're continuing to hire, so that number has gone up, not down. So that's just in direct employment. And if you look at indirectly, right, it's hard to measure, but you're really talking about thousands of employments. And whether it's in the local communities at a restaurant, right, that you know, more money is going into the community because we're hiring people locally, or if you look at our supply chain, because we're purchasing more electricity, that's going to create more jobs in the energy market, and you know, indirectly benefiting the wider state of Texas and the country. So from a GDP perspective, it's undeniable that Bitcoin mining increases GDP. That's just, you know, math. The other part of it too is that ultimately, our conviction is that Bitcoin is going to continue to grow, and that part of that growth is going to be in the value of Bitcoin. And so, you know, if a country is opposed to Bitcoin in general, including Bitcoin mining, their people are going to end up holding less Bitcoin than they otherwise would. So just kind of from that perspective, I think it just makes sense that governments would encourage their population, their voters, the civilians, the businesses, to accumulate Bitcoin. Because long term, if the value of Bitcoin goes up, then those people are going to be spending those Bitcoin into that economy and growing the economy. So I think that it makes a lot of sense to have not just policies that are favorable towards Bitcoin mining, but policies that are also generally favorable towards using Bitcoin and holding Bitcoin. And that's critical for growing the economy.
Yeah, and about that, we want to discuss some of the recent regulation that has happened in the US. Ben, you can comment on that, right?
Yeah, sure. And actually we got a question from one of the attendees, Dan, which kind of relates to both regulatory or rather like institutional sentiment and US Bitcoin mining in regards to the recent merger, February, I think it was in February, between Hut 8 and US Bitcoin Corp. Dan's curious to know if Pierre, you think that this signals more industry consolidation among public US Bitcoin mining companies or otherwise, any other maybe private companies as well, potentially?
I don't have a view on that. No.
No? Okay, so perhaps we'll leave it at that. Okay, in terms of some of the regulatory items that we wanted to cover today, I think definitely we've seen a lot of, action by the SEC recently in a number of things. I think they actually finally got around to taking action on Do Kwon actually the other day, which took a while. And obviously with Kraken, we saw that there was a settlement there with their staking services and a few other things. So I'm curious, just kind of from a broad perspective, because obviously a lot of this relates to crypto and digital assets other than Bitcoin. But do you think, or do you see, whether it's like the SEC or is it the CFTC? Do you see any potential actions or movement from these players into Bitcoin and trying to either put forward some enforcements or some regulations? Curious to know your thoughts in that space.
Yeah, good question. So I think that there fundamentally is just uncertainty in this area. The current status quo is that unofficially Bitcoin BTC is a commodity, and that if we just take that status quo for granted, from the financial regulatory perspective, they see a gap where spot BTC trading is not regulated because the CFTC regulates commodity derivatives, but does not have a mandate for regulating commodity spot markets. And so they see a gap there. Then the debate evolves into, well, the SEC has a much longer track record of regulating trading that is more oriented towards retail investors and traders. And so wouldn't it make more sense for the SEC to have jurisdiction in this area than the CFTC? So I think that's where the debate is currently at. And it's complicated because simultaneously you have these two executive branch agencies trying to regulate, and also that the legislative branch is trying to legislate and try to come up with a solution. So I don't know if there's going to be a solution this year or in the foreseeable future. But that's kind of the current tension over Bitcoin spot trading specifically. Now, there are, if we zoom out, other than Bitcoin spot trading and look at one, on the Bitcoin mining side, there has been interest from the White House in better understanding Bitcoin mining, to put it charitably, and they want to see if the Department of Energy or the Environmental Protection Agency should have a role in gathering information about Bitcoin mining and perhaps setting what they call efficiency standards, which is a big open question. So the White House Office of Science and Technology Policy has put out a request for information about what should the federal research agenda for digital assets be focused on. So that is due March 3rd for folks who like to respond to the government. I've drafted a response. We'll see if Riot sends it in or not. It'll just depend on whether it's a good response or not. But in any case, so there's kind of there is at the federal level interest in the energy angle, but ultimately, I think what is particularly impactful for this space has to do with Bitcoin adjacent assets, right? In the crypto space of, for example, stable coins. There is active debate about how to regulate stable coins, and a major risk here would be that the SEC will decide that all stable coins are unregistered securities, and that they all are more like a money market fund than a token. The industry tries to characterize as that. So I don't know how that would impact Bitcoin. Perhaps it would be bullish for Bitcoin, because really, if the government is okay with centralized stable coins, then it really calls into question why we need Bitcoin, at least at the medium of exchange level. Maybe it still makes sense for the digital gold store of value that, Bitcoin can't be diluted. But for the medium of exchange payment side, a centralized stable coin, there seems to be a lot of interest in using that for payments rather than Bitcoin, if the government allows those things to exist. And these things, they exist at the benevolence of the government, because ultimately a centralized stablecoin can have its bank account seized or frozen, and it immediately goes to zero.
Yeah, that's a good point. I think that it seems as though the government is watching the stablecoin space pretty closely, and maybe it's as a way to inform them of these various central bank digital currencies that have been rolling out across various countries, and some of them are super advanced. I know in Nigeria there's the e-naira that's been rolled out, and there's other countries as well which are starting to use them more for wholesale, I think, use, but also now for increasingly retail use among the citizenry. So I'm curious to know your thoughts about CBDCs, especially as it relates to how it might affect Bitcoin. Do you think that it is a challenge to Bitcoin, or do you think in the long run it actually makes Bitcoin's case more bullish?
Yeah, so I think everything's always good for Bitcoin. So CBDCs, I mean, to me, CBDCs continue the long tradition of governments creating more currency. And so to the extent that they are dilutive, that will be to Bitcoin's benefit. I do think that CBDCs represent a threat to freedom and to human rights. And so, putting aside my enthusiasm for Bitcoin, I think that they are dangerous. And so they have to be contained and fought against, because no matter what the promises made by the promoters of CBDCs, ultimately, because of the first C, right, central bank digital currencies, these are centralized. And so that means that the issuer of the CBDC, even if they launch on day 0, let's say with perfect privacy, the next day they could remove that privacy, right? Because it's centralized. And so no matter what promises the promoters make, it is a slippery slope. And it's not a hypothetical slippery slope. It is a slippery slope that has already been traveled before. And it was traveled by the traditional banking system, where when the United States was founded, we had a right to privacy in the Bill of Rights that said the government has to get a warrant in order to search or seize our papers, or our, books and records or things like that. And that privacy has been slowly eroded because of the third party doctrine. So without a doubt, any kind of issuer of CBDC would look for ways to control the people who are using that currency. And that is extremely dangerous. So I think that it's something that, to me, it's astonishing. There are people in the United States who want CBDCs. And that really reflects poorly on their judgment. But ultimately, I don't think they will succeed, because I think they're in a very small minority of the population.
I tend to agree with you on all those points. I think there's always people closer to the money who tend to, be attracted to that position. But we are coming up to the end of the hour, so I want to get a couple of the client questions, or rather the audience questions here. So one question is, what do you think about Bitcoin dilution regarding perpetuals and the derivatives market? And do you see any parallels to how, do you see any parallels to the commodity markets with gold and silver or other commodities?
Yes. So if we look at Bitcoin's price history and the history of the derivatives market in Bitcoin, because of the volatility, we've seen a lot of leveraged traders get liquidated. And so trying to manipulate the Bitcoin price using derivatives is a great way to get yourself liquidated on a long enough time frame. So I'm very skeptical that that's going on. One could imagine that the Federal Reserve or a central bank that has infinite amount of fiat currency could, avoid getting liquidated and build up very large positions to try to manipulate the Bitcoin price. That's possible. I mean, I still think the outcome would be highly inflationary, because they're introducing so much fiat currency into the system in order to manipulate the price, that ultimately, like, Bitcoin's price, and any market price long term, is going to reflect fundamentals. And so I think that people who talk about gold price manipulation are kind of in a state of denial about how bad gold's fundamentals are, and are trying to find ways to rationalize why the price is not where they expect it to be, rather than accepting that there's a better alternative now in Bitcoin.
Yeah, maybe some of the gold bugs have started investing in Bitcoin. So a last question from the attendees: is there a plan to add, when we're speaking about vertically integrated businesses, is there any plan to add rig manufacturing in the future?
So can't comment on that specifically, but what I will say is that Riot's, I talked a lot about Riot's different competitive advantages in the Bitcoin industry, and all of those are symptoms or derivatives of its core competency, which is the people who work here. And so really, at the end of the day, the only reason why Riot is able to build what it builds is because of the individuals here who come up with these innovative ideas, who put in the time to actually turn them into reality, and who are doing the proof of work. Right? I think proof of work, we often look at the mining rigs, but the proof of work is in the people that are actually operationalizing everything. And so for any kind of vertical or horizontal expansion of the company, it starts with people. And if you're looking to start a career in Bitcoin, go on Riot's LinkedIn page, look at the roles we have open, and join the team. And if you don't see a role there that fits, feel free to reach out. Let me know. Maybe there's an opportunity.
Awesome. I think that's a good note to end here on. So thank you very much, Pierre, Julio, and Key. And thank you very much for all the attendees. We're going to be recording, well, this session was recorded, so we'll be posting it later. And yeah, we'll follow up with anything else. Pierre, thanks again for joining us.
Yeah, thanks for having me on. This was a pleasure.
Thank you, Pierre.
Thank you, everyone. Have a good day.
Bye.
Bye.